Good morning, excuse me, and welcome to this Wednesday, October 19th, 2022 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, volatility obviously extends into after hours action because last night it looked like we're going to be off to a good start this morning. Netflix came out, blew away estimates, added, I think, 2.4 million subscribers. Things looked pretty good. Futures were pretty solidly higher, with the NASDAQ leading the move to the upside. And then this morning happened. And we've got currently, well, as of about 10 minutes ago, we have futures, Dow futures down 143 points. S&P futures down about 22, 23 points. NASDAQ futures down 67 points. So on a relative basis, the S&P and the NASDAQ both down about 0.6% to lead to the downside. So what changed? Pretty simple. Interest rates. U.S. 10-year Treasury yield today up almost 10 basis points to 4.10%, setting a new 14, 15-year high. That is clearly not what the bulls want to see. The bulls would like to see that 10-year Treasury yield come down. But currently, that's not what we're seeing, in the market reacting accordingly. This morning, before we get into things, for those of you who are new to Earnings Beats, let me get you set up over here. If you go to earningsbeats.com and you simply scroll down, about halfway down the page, you'll see an area where you can sign up for our free Earnings Beats Digest newsletter. This is a 3 times a week newsletter, Mondays, Wednesdays, and Fridays, out about 8:30 in the morning. Try to get it out about an hour before the market opens. Sometimes we run a little bit late, or I should say sometimes I run a little bit late. But normally we try to get it out by about 8:30 in the morning. All it takes to subscribe is a name and an email address. No credit card required. There's no charge. You can unsubscribe at any time, but we try to make it educational. For me, I'm just trying to give something back to the community. We have a very, very large following. If you'd like to join, again, just go to earningsbeats.com, scroll down. One last thing, we do have free events, many free events throughout the year, and we always reach out to this free Earnings Beats Digest community. So another reason to be a part of this is simply to be aware when we have these various free events. We got another one, a big one coming up in a couple of weeks that we will be announcing shortly. You can mark your calendar, though. It's going to be on Saturday, November 5th. It'll be probably a good solid hour to 2 hours. I mean, it's going to be a good event. More about that to come. But in order to participate in all of that and to get this free newsletter, go over to our website, earningsbeats.com, scroll down, make sure you sign up with your name and email address. All right. Let's take a look at what happened on Tuesday. So I guess it's kind of good news, bad news kind of thing in terms of the action from yesterday. First of all, we saw really good action at the opening bell. We followed up with nice action on Monday, solidly higher prices Monday with a big opening gap up. The QQQ, for instance, which had closed on Monday. The QQQ is the ETF that tracks the NASDAQ 100. So many of the large cap growth names, Apple, Microsoft, those types of companies. The QQQ had closed on Monday at 269.49, and it opened yesterday at 276.53. Opened up $7, which was roughly 2.5% at the opening bell. That was the good news. The bad news was it was all gone in the first hour and a half to hour and 45 minutes of trading. And, for me, I think the big reason was the fear of interest rates. And the most, surprising part was interest rates yesterday were pretty flat and were down until about 11 o'clock, 11:15. But it was almost like the stock market was anticipating they were going to go up, because all of a sudden, middle of the day, the 10-year Treasury yield went up from under 4% to about 4.06%. But then by the end of the day, it steadied back down near 4%. We saw the late afternoon, last hour, we saw the market rally. And then after the bell, Netflix comes out, and we hadn't had a single trade on Netflix above $250 a share for several months. They came out, reported better than expected numbers, the big add to subscribers. The stock was up, I don't know if it was up to 275, I think the last time I saw. And this morning, let me see if I can, we'll go take a look at that real quick. So this morning we've got Netflix up still $25, 266, but that's down quite a bit from where it was in after hours yesterday, but still up 10%. Not going to matter, at least not for now, because you can see the QQQ currently down about nearly that 0.6% that I was talking about. Yesterday, the QQQ was up about a 1.5%, 1.25 to 1.5% after hours. So it was a big turnaround overnight. We'll talk about that in just a minute, talk more about that in just a minute. But looking at the action from yesterday, when you look at this, you say, well, it was a pretty good day. Well, again, when you gap up and you're up 2.5% on the NASDAQ at the beginning of the day, and you finish up 0.9%, that doesn't really feel like a good day by the end of the day. So Dow up a little over 1%, S&P 500 same, NASDAQ just beneath that 1% level, mid caps up 1.45%, small caps up 1.16%. So we did go higher across the board. We did close above the 20-day EMA on 4 of the 5 indices. The only one that failed to close above the 20-day was the NASDAQ. All the others closed above. And with positive divergences everywhere on the daily charts and also on the weekly charts, I'm looking for a move up to 50-day moving averages potentially to reset those PPOs back near their center lines. Or are we going to, I mean, it's not a guarantee, but to me, if you study history, I think your odds improve that you're going to get through the 20 and you're going to make a move for the 50. The bond market might have something else to say about that, though. And again, we'll talk about that in just a minute. Moving on to the sectors, industrials were the key or the big winner yesterday, up 2.4%. Industrials on a relative basis have actually been performing very, very well. And this has been one of the steadier groups, if not the steadiest, among the aggressive sectors throughout 2022. So industrials have held up fairly well versus the overall market throughout this year. They've been down. I mean, you can see we just set a new 2022 low at the end of September and tested it recently last week, but we just haven't been down as much as the S&P 500. So we've been showing relative strength there. Materials down, up almost 2%. Utilities up 1.8%. Financials 1.6%. Discretionary 1.38%. Discretionary tailed off throughout the day. Notice technology missing from this list of the top 5 yesterday. Communication services, which include internet stocks. The same groups, semiconductors, software, automobiles, internet. These are the ones that are struggling right now in the market. These are the growth areas, the really key aggressive growth areas that are going to drive the next secular bull market advance. They're not driving anything right now. And that, when you just look at the rotation that's been taking place in the market, that's really what's missing. And until that turns around, we're probably not going to do much more than just consolidate. And honestly, if we're not getting any participation from semis and software, internet, autos, some of the groups that have been big winners throughout this secular bull market, if we're not getting help there, going sideways is a really good thing for the market. That tells you that there's still plenty of buyers. It's just not in those groups. Anyhow, moving on. Let's see here. Next up, 10-year Treasury yield. So this is where I think the problems are in the market. I'm a former practicing CPA. I did valuations. When you get interest rates going up like this, especially as fast as they are rising, it's not good for valuations. It doesn't even matter what companies are doing. Netflix comes out with a great report, beats their earnings estimates. Even if their earnings continue to grow in the future, when you've got rates on the rise, future earnings estimates, future earnings growth rates are not valued the same as rates are higher, because what you do is you take those future earnings and future earnings growth rates and you discount them back to today's present value based on current rates of interest. And as rates go up, you're discounting those future earnings more and more and more. If rates come down, it's the opposite. Companies do nothing and their valuations go up simply because rates come down. So we've got to keep an eye on interest rates. This is the big driver right now, in my opinion, on when we're going to really begin to take off in the stock market. We're not going to do it, I don't believe, with 10-year treasury yields continuing to set new highs. We need some kind of a catalyst. I don't know if it's an inflation report. I don't know if it's comments by the Fed. I don't know what it is, but we need something that reverses the 10-year treasury yield. As long as this keeps going up, we're going to struggle. And if it keeps going up, we're going to break down again in stocks to the downside. I'm convinced of that. Now, I don't believe the 10-year treasury yield is going to go up. I mean, to me, I think the Fed's playing like a mini game of whack-a-mole. You know, you're trying to stop inflation, but inflation's, you got two things. You've got demand, you got supply. Those are the two keys to inflation. You just have too much demand for too little supply. That goes back to economics 101. The problem is with every interest rate hike, the Fed is banging on the whack-a-mole hole where the demand is. Well, the mole's not popping up there. Demand is being crushed by the Fed. The problem is on the supply side. And so it's a matter of time before we get all the shortages through the system and we're able to catch up to demand. I think eventually we're going to have supply catch up. Demand's going to be crushed by the Fed. Inventories are going to build, and then we're going to have deflation because companies are going to have to start lowering prices to sell product. That's what I think's going to happen. When it happens, I don't know. I don't know how much more the rates are going to go up. I did not think we'd ever see at this point this year 4.11%. I'll be honest. Just didn't see it. I thought 350 after we went back down, we started moving back up. Okay, maybe we go back to this 350 level. Since we've broken through the 350 level, that's when really things, well, maybe even this trend line right here. We were in like this little channel going down. Remember, that's when the market was going up, June, July, August. When you think about how much we've gone up here in terms of the yield, I think it's pretty amazing that the S&P 500 is still held up as well as it has. Now, you've got some growth areas that are not doing well, but the overall S&P 500 has held up, which means there's still buyers out there. It's just that they're not buyers in the right areas. I want you to look at this 10-year treasury yield chart here. And by the way, we had one economic report out this morning. That was September housing starts and building permits. Housing starts came in below expectations, not too much of a shocker there. 1,439,000 units. The estimate was 1,475,000 units. So we came up 36,000 units short. August was 1,575,000. So we were expecting 100,000 drop, and it turned out to be 136,000 drop. So the number of starts definitely heading in the wrong direction. However, one encouraging sign was building permits. August, we saw 1,517,000. In September, the number came in at 1,564,000 versus an estimate of 1,550,000. So we were already expecting building permits to go up, but they went up even more. And I don't know if I should take this bullishly or bearishly. Normally, I would say, hey, that's good news, economic growth. You know, I mean, the housing market still, I mean, building permits is an initial sign to future housing starts. Most areas of the country, you can't start housing projects without getting building permits. So the fact that building permits are up is a good sign. The problem is that's not what the Fed wants to see. The Fed's trying to crush the economy. That's their goal, kill demand. That's their answer to squashing inflation. Kill demand. Well, demand, in my opinion, already has been coming down. But, you know, you look at a report like this and then you scratch your head and you say, well, it doesn't look like housing group is necessarily coming down, not with building permits going up. So there's just this mixed signal. But what I want you to look at here on this chart on the 10-year treasury yield, this is a weekly chart that goes back 5 years. And if you notice when we really started to make our way down in the 10-year treasury yield, this was back in the fourth quarter of 2018, by the way. Remember the trade war related cyclical bear market? The S&P went down 20% in these 3 months. It was a very, very brief cyclical bear market. And if you remember, Fed Chief Powell was talking about rate hikes back in December. They talked about, he said 2 rate hikes coming. And I was looking at things at the time, various signals, and I'm thinking there's no way they're going to be hiking rates. And I even wrote about it. I think it was back right around Christmas of this in December of 2018. Probably go back and look at one of my Trading Places blog articles, or maybe it was in the Chart Watchers. I'm not sure. But anyhow, the Fed never raised. The Fed ended up lowering in June. And look what the bond market was already pricing it in. And you can see in November and December, bond yield, 10-year treasury yield had gone down to its lowest level since back at the beginning of the year. And yet the Fed's talking about raising rates, bond market saying no way. And bond market usually is pretty smart. So anyway, that was a sign that rates were probably heading lower. We ended up getting a rate cut in June. You can see that started a really steep drop in the 10-year treasury yield, which was exacerbated by the pandemic. I mean, the economy fell apart. You can't close our entire economy and not expect a huge drop in GDP, which we saw. I think it was, I don't know, minus 33% or something like that in the first or second quarter. I think it was first quarter of 2020. Anyhow, that big drop in the 10-year treasury yield, look at the QQQ versus the spider. So this is the more growth-oriented index versus the more value-oriented. There's still, the spider has lots of growth stocks in it, but the QQQ is like growth on steroids. So QQQ versus spider for me is a growth versus value index or ratio. So look at what happened though as the rates started coming down. You see what happened with the QQQ taking off when rates dropped. You know, everybody's saying, oh my gosh, the economy's stopping. This is horrible. And it was. Companies, even growth companies, were getting killed. But look at the relative valuations. Why was that happening? Again, it had nothing to do with business. It had everything to do with interest rates. When interest rates drop to those ridiculous levels, future earnings expectations of growth companies are valued through the roof because you're not even discounting. When you're getting down close to 0%, you're hardly even discounting. But I want you to look, as we stayed between 0.5% and 1% through the end of 2020, look at these ratios doing really well. And then we saw the sudden surge in rates above 1% to 175. Look at the ratios, down. Then we got a little bit of a reprieve in rates, coming back down below 1.5, down to about 1.2%, right? Look at the growth ratios turning back up again. What happened when we broke out the beginning of this year? That led to a lot of upside, and it also led to not only the cyclical bear market that we're in, but look at what the groups that are underperforming. QQQ versus spider, IWF versus the IWD. This is large cap growth versus large cap value. And so, you know, I don't know what to make of it at this point, but we've broken out to new highs now on the 10-year treasury yield right here. And the QQQ finally has gone down to a new low. The IWF has not. I'm going to show you some other ratios. Let's take a look at those now. So here's the S&P 500. This is just the last 2 months. So this is going back. This was the big Jackson Hole speech on August 26th when Fed Chief Powell said we have more pain ahead. This right here was the August CPI, which came in hotter than expected. So we had been going up into that report that came out, quickly erased all of that. And then this gap down right here and the reversal, this was the September CPI report last Thursday morning when we had the big gap down, then we started rallying. And I think a lot of this rally is manipulation. If rates keep going up, I got to believe the S&P 500 is going to go back down again. The good news is, if there's good news here, is that the 10-year treasury yield right now, if you look at where we were back in June, We had gotten up to about just under 350. Now we're at 410. We've gone up 60 basis points. And when you look at the S&P 500, and let's stretch this out a little bit longer now. When you look back over the 1 year, here's June. This is when we were at 3.50%. Now we're at 4.1%. And the S&P 500 right now is actually higher by about 50 points, 37.19 versus a close of 36.36. I think that was the low close. That's a little more than 50 points higher on the S&P. So no one can convince me if rates begin to pivot and start to move back down, I believe the stock market's going to take off. That's what I've been saying, even back at the beginning of the year when I called for a cyclical bear market. And I said we could go down to 3,500, 3,800 worst case. Even back then, I said, once we get there, we're going to have a big rally in the fourth quarter. Now, we haven't seen that yet we're up maybe about 100 points so far in the month of October, but it's been incredibly volatile. But I believe we're going to have a big rally. And I think by the end of the fourth quarter, we could be up anywhere from 10 to 20%. That's what I'm thinking. But in order to do that, I'm telling you what I'm banking it on are rates topping and coming back down. If rates keep going up, all bets are off. But if rates top, and I believe they will, and they start moving back down, I think Wall Street's going to anticipate continuing moves down in rates. And I think you're going to see these growth stocks, which have been getting crushed, all of a sudden start to take off again. Now I'm going to pull up, next thing I want to show you is our strong earnings chart list. And what I've done, these are, I think, 400 or 450 companies. Let me see. 450 companies on this list. These are all companies that have beaten Wall Street estimates as to both revenues and earnings in their most recent quarter, just one quarter. They had to have beaten both top line and bottom line. If you beat one and you match the other, you don't qualify. You have to beat your revenue estimate. You have to beat your earnings estimate. These are companies that obviously are executing on a high level, which are kind of near and dear to my heart. Being, again, former practicing CPA, I like companies from a fundamental perspective that are executing, that are beating estimates. That's step one. Step two, they have to be liquid. So I don't want a company that's trading 5,000 shares a day. We hand these lists, all of our research over to our members. We don't want, illiquid companies on the list that folks go out and trade and then not be able to get out of or have huge bid-ask spreads. So liquidity, got to beat top and bottom line, got to have liquidity. And then finally, there's got to be something compelling on their chart. Either they're a leader in their space is a leading group. Maybe they're not great, but their space has been very strong. And now they've beaten. And so we want to kind of watch them. They may take off. But there's got to be something compelling from a technical perspective. Maybe they've been going down, but they have a positive divergence. I don't know. There's got to be something compelling technically to get them on this list. 450 companies. So let's take a look at the summary again. And I've got in terms of the summary, I want to set these up in scooter order. Let this come up here for a second. Let's refresh. Almost. There we go. Okay, so it's in scooter order. Now, if you look at the high scooter scores, look at the sectors and the industries that are represented. Energy, 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 energy. So 4 of the top 10, 15 names are energy. There are a few technology. You can see technology here, but it's renewable energy. Electrical components. Here's one semiconductor. That's an interesting one because semiconductors have not been strong. So any company that has a high scooter score, if we take a look at that. Oops, I've got this set up on another. That's not good. Probably not gonna be able to look at charts. Anyway, let me see where, I know where else I have it. Let me go over here and get out of it. It's probably gonna be 5 minutes now before I can use this. you can use your count on 2 different machines when you're outside normal hours. But I think once you get close to the market open, then they begin to monitor. I don't know if anyone's had that issue before, but you have to be careful. Anyway, we're gonna have to wait probably about 5 minutes till the market opens, but that's okay. I wanted to spend some time looking at this anyway. So if you look at the strong earnings chart list that we have, and you go down in scooter order, my point is that at the top, all the companies that have been really strong have been areas of the market for the most part that have been strong. Some of the industrials, marine transportation has been on fire. So you can see all of these marine transportation stocks are up near the top. Energy, you got exploration and production stocks, integrated oil and gas, coal, a couple more exploration and production companies down here. They've actually or obviously been very hot. First Solar within the renewables been hot. Let's see what else is here. Here's a discretionary stock. Not too many discretionary stocks up near the top, but here's one. CCRN, that's Business Training Agency. Another one, PDD, which was a stock that we tried to trade recently, got stopped out on it among our model trades, but it's actually got a nice scooter ranking of 98. And so anyway, that's the top of the list. But let's look at the bottom of the list, because if the market gets going, when we look at the bottom of the list, we're going to find companies that have been torched because of these high rates. And you're going to see the groups: software, 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 semiconductor, software, software, semiconductor, software, semiconductor, software, semiconductor, software, internet. I mean, this isn't rocket science. These are high growth companies that do extremely well in bull markets and not so good in bear markets. But they have been beaten up so badly over the last 9 or 10 months. If we get any hint of lower rates, even if these companies are having issues in terms of their profitability, just the rates coming down themselves, we're going to see a big pop in many of these stocks. So this is an area of the market that you really want to be paying attention to. Do you want to go jumping in now? I say no. When they get going, they're going to get going for a while. You'll have plenty of time. The problem with trying to time a bottom in these stocks, I think a lot of it is trying to time the top in the 10-year treasury yield or in yields in general. It's not an easy thing to do. Even though I believe we're going to top, we need some kind of catalyst. Look for something big in the bond market, a big reversal where maybe intraday the yield's up, and then by the end of the day, we're down 25 basis points, something like that, 15, 20, 25 basis points. We need a reversing candle to go with these these negative divergences on both the daily and the weekly charts of the 10-year treasury yield. So again, you go back here. This is just the daily, but there's the higher price, that lower PPO. That's what we want to see. We want to see some sort of a reversal there. All right. So let's just scroll down here. Let's see some of the others. So we have mortgage REITs in here, by the way, and the real estate. Real estate's been awful, horrible for the last 2 months, but it's been one of the best groups this week. Opposite George week. This is option expiration Friday coming up in just a couple of days. I suspect that if rates keep going up and the market somehow manages to hang on to some gains going in toward the end of the week, I think you're going to want to batten down the hatches for next week. Historically, it's the worst week of the year. October 21st on the close to October 27th on the close is the worst week of the year historically. October 21st is Friday. So technically it's the close on Friday. So if you're following history, if that's something that you really follow closely, and you do believe that we're just being manipulated higher right now because of options expiration, be careful, at the close on Friday, maybe consider minimizing exposure going into next week. I certainly would not be in anything like juiced ETFs, leveraged ETFs. Not what I'm seeing, not if 10-year treasury yield keeps going up. I'd be really careful next week. But anyway, some of these other stocks, I mean, look at all the software and semiconductors that are just littering this list to the downside. Now, you do have some, I mean, healthcare providers haven't been bad. So this is actually one of those outliers on the bad side. I mean, if you're in healthcare and especially healthcare providers and you're not doing well, there's something wrong with your company, because healthcare providers have been extremely solid. Let me see if I can get the chart up. Nah, it's still not letting me get the chart up. Well, what I can tell you is, because I wanted to get, let me see if it'll give me the dashboard. Okay, we can at least take a look at what's going on. The market just opened, by the way. So we're a minute in. NASDAQ is down 67 points. S&P 500 down 16. The Dow is down 36. This is going to be a really interesting day. And I say that because the market still has incentive to go higher with options expiration. But is it going to go higher when the 10-year Treasury yield is up 9 basis points to 409, setting a new 14, 15-year high in the 10-year Treasury yield? That normally would be, I mean, when I showed you when the yields are going up, growth stocks go down, the QQQ markets go down. And right now the market, it's interesting because yields are going up and market makers have the incentive for prices to remain high. And whether or not that continues, well, we're going to find out later today. But right now we've got, we're getting off to a little bit of a bad start. Maybe we'll get some buying later in the day. We'll see. Anyhow, that is it for me. I appreciate everybody tuning in. Be back tomorrow over at Stock Charts TV for your next episode of Trading Places Live. Simply go over to Stock Charts TV right there at that link. And at 9:30 tomorrow morning, just click on it and the show will come up. It'll be a recorded version, but I'll try to record it in the morning tomorrow, try and get as close to the open as possible. Anyhow, everybody have a great rest of your day. And later today, I do want to mention we're having our model ETF portfolio draft. This is where I fill out our portfolio every 3 months with new ETFs. That will start later this afternoon at 5:30 Eastern. So members, you'll be given some instructions on how to get in later today. If you're a non-member and you're interested in ETFs, you want to see how we put these ETFs together, and check out our ETF Analyzer, which is an unbelievable tool. You can sign up for our free. You can sign up free at our website right here. Start a no-cost 30-day trial. So you have to give credit card for that, but 30 days for free. And come in and join us later this afternoon for the model ETF portfolio draft. Anyhow, again, everybody have a great day. See you tomorrow. Happy trading.